because it looks like people, as rates are moving up, people are having a difficult time going out and purchasing the homes, and we see nationwide that housing sales are down. Is this move that the Fed is doing, where they're raising rates, unwinding, is this going to ultimately help the economy or hurt the economy?
Well, it's a double-edged sword, because it puts the Fed in a very tough situation. For 8 or 9 years, what they've done is they accommodated the economy by expanding the credit supply, while many corporations and individuals were looking for to get cashed up. So they were expanding the monetary supply when there was real demand for dollars, by corporations, by institutions, by banks who wanted to be cashed up and sovereign again after the 2008 crisis, and by individuals as well. And so what you saw is the central banks monetizing and expanding via QE programs and asset purchases, and you saw a dollar bull market as well at the same time. So, but this trend has stopped around 2015. Many institutions felt cashed up, and they didn't need more money. They didn't need more credit from the Fed. So the Fed started reversing trends. You saw a lot of the big banks like JP, like Goldman, having excess reserves of dollars. They didn't know what to do with them. So the Fed obviously communicates with these banks, and they reversed course and start raising rates, start unwinding their portfolios, and they signal to investors and to the international community the U.S. is getting better. The economy is getting better. We are now starting to tighten monetary policy and get back to normalized interest rates, etc. But when you do this puts you in a very tough situation. Why is that? It's because there's no way they can reverse course once more. And so the Federal Reserve is now going to raise interest rates and unwind. There's no surprises here. It's not going to stop doing it. It's not going to reverse course again and lower interest rates. It's politically in a situation that's very tough, because they can't use many tools. They only have one tool. They can either tighten or say, okay, we're going to hold until we tighten again. But the trend is tightening. The trend is unwinding, right? And so every time that the stock market, which is their major testimonial of their success to the world, that's how they broadcast that their policies work. Here you see the markets are going up. Every time that the markets are going down, they can't ease. There is no insurance anymore for investors. So anytime there was a dip, the Fed would come in, they would buy assets, and the market would get propped up. They can't do that anymore. That will show signs of weakness. So they're at a spot where investors who are, big Wall Street banks, they know this. They know the Fed is in a tough spot. And so anytime that there's a correction, they're going to short the market themselves, the Wall Street gangs, and they're going to create rougher corrections, and they're going to shake out all the rookie investors that came into the market in the last 2 years, and they're going to make a lot of money on volatility and fees. And so the Fed is in a very rough spot when it comes to what they can do, even as they see the stock market correcting down. You see what I mean? On the flip side, more power is going to the government. And so fiscal policy is becoming much more important than monetary policy. Again, monetary policy is pretty fixed right now. They're going to either tighten or hold and then tighten and raise rates 2 months later. It doesn't matter. The trend is tightening from now on. And then the government will be the one that is toiling away and working creatively to try and create an economy that's more robust. So tax cuts, the tariffs, the infrastructure plan, it's all part of fiscal policy and all part of what the administration can do to get the economy to move at full force going ahead. But since it's a very tricky game now with regards to how overheated the economy can get, the Fed is actually the enemy of the government. So we're going to see them clashing with each other with regards to policy, and that's something we haven't seen in the last 9 years. The government and the Fed going at each other with regards to how much the Fed needs to tighten, how quickly they need to tighten. It's a very unique period because you see two different megastructures, the government and the central banks, basically needing to coordinate with each other, and that's very, very hard to do.
Do you think that's being done on purpose, where the government now and the Fed, the central bank, they're on opposite sides? Because normally the central bank works with the government and they're kind of in sync. Now we see the opposite happening. You think this is being done on purpose?
No, I think you got to realize that the end of cheap borrowing costs has arrived. For a long time, if you look at the inflation chart in the U.S. at the CPI year over year, since the early 80s, it has not been over 2%. Now, given 30 years worth of 2%, that's going to kill a currency. That's going to create a purchasing power crisis, and it has. In America, the purchasing power of the dollar since the 80s has gone down substantially. But mainstream news, for the mainstream media to cover inflation as a topic, that has not happened since the 70s. And it's going to start happening this year. You already see Bill Gates, Paul Tudor Jones, Jeff Goldbach, Ray Dalio, and a lot of the biggest bond managers and a lot of billionaires telling you, hey, we have a serious situation here. Interest rates are very low. Corporations have access cash, and with the tax cuts, they can raise wages. And by the way, Dave, there's a shortage of jobs in America. People don't realize that, but since there's 100 million people are out of the workforce, there's only 200 million people in the workforce, and it's shrinking every day because more people are retiring. For corporations to attract people to come back to the workforce, or for them to attract skilled laborers from the millennial generation, they're raising wages. So wages are becoming elevated again in the United States after a long, long time. We haven't seen a 3% raise in wages for a very long time. People believe that inflation occurs because commodity prices rise, but that's very marginal. In a $1.50 loaf of bread, there's about 8 cents worth of wheat. So if the wheat price doubles, it's not going to affect the price of the loaf that much. But if you have to pay the baker, the delivery boy, the trucking company, if you have to pay the people working at the gas station and all the people in the supply chain, if you're raising their wages, that's going to affect the bottom line, and that cost will be moved on to the consumer. And so inflation is becoming the real problem in the economy. Between 2008 and today, inflation wasn't a serious problem. It was a serious problem in some respects. Rents have gone up, tuition has gone up, but we haven't seen what's called general inflation, where all prices, no matter which sector, they're generally rising. And that really is detrimental when we saw that in the 70s. Companies, CEOs, they can't plan for the future because they don't know their costs. And because they don't know their costs, investors are getting jittery about holding stocks. So stocks valuations go down. Stocks valuation goes down. CEOs have to think about hiring. If they have to think about hiring, then it means their bottom lines are shrinking. If their bottom lines are shrinking, that they need to perhaps fire. That stalls the economy, and that's how we roll over into a recession. That is how inflation causes the stock market to peak, and that's how the stock market peaking causes recessions. It's very predictable, very cyclical, and I can tell you this, historically, since from the time that inflation starts being a mainstream problem, you have about 2 to 3 years before you roll into a recession. And between that and today, the stock market peaks. So that's the order. Inflation becomes a problem. The Fed tightens. When the Fed tightens, it stalls the economy. The stock market peaks because people and investors start to choose bonds over bond yields, higher bond yields over elevated stock prices, and they move their money a little bit out of the general equities into commodities, for example. So you see commodities trading inversely to the stock market. So we're going to see this starting to happen, and this hasn't been the case for a long, long time, as you know, because you interview a lot of people in the gold space, and gold, at least the gold equities have gone down a lot in the past few years. That's going to change right now with inflation becoming a problem. People look at the hedge, and then once that happens, recession is next. So the Fed and the government are really at odds here, because the Fed's job is to make sure that the economy doesn't overheat, and inflation doesn't become a serious problem, like a 4 to 5 to 6% problem, which is insane for an economy as large as the United States. And on the flip side, the government doesn't want you to roll the economy into recession, and they love people having more discretionary income, because obviously that's much better for them politically. Their approval ratings go up if people feel richer. But if people feel wealthier and they go out and spend, that starts getting the velocity of money higher. And so you see two conflicting things here that are at odds. The government wants people to have the wealth effect, and the Fed knowing that this is not a wealth effect. This is actually money in your account that you're ready to spend. And if they don't normalize interest rates, that's going to trickle into Main Street inflation, and that's going to be very problematic for corporate America. So very unique period, Dave.
So when you talk about inflation, you're talking about like bread, milk, the everyday items that people use where they're going to see the costs move up. And if that does happen, that usually means that the dollar is losing value because it takes more dollars to buy that same product. Gold should, in theory, then move up unless they manipulate it. Do you see gold breaking out during this period?
So first of all, the US dollar index is already down about 10% since peaking. So it's very close to that important number, 86 on its index. If it goes down below 86, it's officially in a bear market. And if it's in a bear market, that bear market lasts for a few years, normally about a business cycle, 7 years. And you're going to see a lot of inflation if that happens. So as we're doing this interview, we're at a very critical point for the US dollar. In my opinion, the trend will continue to go down, and we will enter an official bear market for the dollar. And when that happens, obviously it's very favorable for gold. Gold prices, the spot price is already up about 30-35% from the bottom in 2015 when the Fed started raising rates. What hasn't followed suit is the gold equities and silver. Those are lagging. Obviously, silver is the leading indicator for gold equities to go up. When silver starts rising and trades at a large premium to its production price, like it did when it traded for 40, 42, 44, 49 back in 2011, then gold equities go berserk. But for now, you don't see that happening. Again, when you're an investor and you look at the reasons to buy physical gold, the reason is because you want money outside of the banking system that you have put aside that is very inversely correlated with fiat currencies. So the best time to buy gold is obviously when things are more favorable for fiat currencies, because you want to buy more of it. You just want to own more of it. And so the best way to do it is either dollar cost average it out through time, or just make bigger allocations when it's trending down. Right now it's over 1320, which is an important price point for it. But the big price point is over 1378, which was its intraday high in 2016. If it breaks above that, then it's officially inside of a renewed bull market because it's piercing through the resistance back from the August 2016 high, Dave. So I see that as an important point. But for me, the big thing here is silver. It's trading at an 80-to-1 ratio to gold. It's traded at an 80-to-1 ratio for 3 times during the last 30 years. So it's very rare to see silver this cheap. And usually once this ratio starts to shrink back down to the 65 to 50 to 1, the gold shares follow suit. And so this is a very, very interesting time for the gold space. We'll see what happens. But definitely the trends are very favorable for gold. Look, for in the bottom line, gold and gold equities, they move higher when the dollar is in a bear market, which is about to happen. But also, what you need to realize is that stocks need to underperform. As long as stocks perform, people want the yield and the appreciation that the stock market provides over holding gold, which is for many traders, it's just an inflation hedge. As long as the inflation wasn't a problem, they don't consider gold as money. They buy the GLD ETFs. So for institutions to really buy gold and for investors to buy physical gold and bid up the price, there needs to be a real problem of inflation in the mainstream media that causes a lot of institutional buying, because clients call their fund managers and say, hey, are we allocated into gold? Are you buying gold yet? Because I saw on TV that such and such is the CPI is up, or GDP is up, or the Fed is worried about inflation. As you know, the Fed has bought $1.8 billion worth of TIPS, which is the treasuries that are inflation protected. So everyone knows that inflation is becoming a problem. Once the CPI numbers, the next ones come out, if it becomes a genuine, talk on CNN and CNBC, you're going to see a real change here. And that's what I think is missing for gold to really break out here.
Now, I wanted to move on to cryptocurrencies. And we see the central bankers, the IMF, we see the Fed. There were 2 economists out there, Jamie Dimon, the Biz. They're all bashing cryptocurrencies. They're telling us that it's not real currency. It's created out of thin air. Criminals use it. Terrorists use it. And they don't see it going anywhere. Actually, Bank of America, Citibank, and others have filed a report with the SEC where they say that cryptocurrencies, that is a threat to their business. But then on the other hand, we see Amazon, Facebook, they're looking to get into maybe Litecoin. PayPal has filed a patent for a crypto payment system. So on one hand, we have the central banks. They're telling us that it's a threat to their business, to their system. It's not real money. And the other hand, we have, companies looking at the cryptocurrencies. Actually, out in Germany, they decided not to tax cryptocurrencies when you make a purchase. So, and let me just throw in Venezuela, where they created their own cryptocurrency outside of the dollar. So when you look at the crypto market and you see what's going on here, are the central bankers right? Or is cryptocurrencies, is that some type of currency that people will be using?
I think right now, Dave, it's important to really distinguish between cryptocurrencies and crypto assets. So overall, all of these cryptocurrencies are born into existence because of technological advancements. So the GPU cards or the exec cards, it doesn't matter. It takes technology to create cryptocurrencies. This is a tech sector, and people need to realize that what they're seeing is digital tech assets. Within this sector, which includes now around 1,500 projects, there are projects that are aiming to become viable means of exchange, viable currencies. Their daily fluctuations are about plus to minus 7%. As chairman of High Blockchain Technologies, Frank Holmes just told me in an interview, and this is a lot for a currency to go up and down every day by 7%. You cannot pay and build an economy on that. Currencies must be much more stable. Hence, the reason that gold and silver were used as currencies or as money, as means of exchange for so many centuries. So you can call them cryptocurrencies, but what they really are is aspiring to be cryptocurrencies. And for most of them, they're not even aspiring to be cryptocurrencies. They're aspiring to be digital assets. So if you look at some of these projects, what they want to achieve, what they want to solve is not a problem that has to do with currency. A currency, what it wants to achieve is be global, be fast, cheap to use, easy to store, easy to maintain, easy to manage. That's everything we want from a good currency, and obviously not inflationary. Bitcoin is aspiring to be one. Litecoin is aspiring to be one. Dash is aspiring to be one. Monero is aspiring to be one. They're not currencies yet, obviously, because there are many open questions regarding them. And then you have many other cryptocurrencies that are not currencies at all, or not even aspiring to be ones. And so the name cryptocurrency is a outdated name. They will be called in a different name in the future, because some of them are basically decentralized or centralized projects that are trying to solve real world problems. Some of these problems have to do with solutions that banks now solve, and therefore the name currencies was attached to them. So if you're trying to solve a problem of faster confirmation time or cheaper fees for wiring money, those are things that banks are solving, and therefore these are currency issues. But if you're creating new softwares that do this or anything else, that's you're not creating currencies. You're creating tokens, and you're creating projects. So the way we look at it at Wealth Research Group is we look at this as a tech sector, which is now just starting to boom. It's gonna definitely stick around. You might mine cryptocurrencies from computers and servers, and not from the crust of the earth, but that doesn't mean it's out of thin air. That phrase "out of thin air" is more relevant to if you can decide at any given point to increase or decrease the money supply. That means out of thin air. If you can just create credit that other people are forced to use, that is called out of thin air, and that's what governments and central banks do. It's different than how cryptocurrencies are mined into existence, because if you mine coins into existence, it means that someone had to transact. So the initial thing here was there was demand for a transaction, and therefore a miner got rewarded with new coins. So you see the difference here between how fiat currencies are created because of credit constraints and credit and booms and busts in the economy, where cryptocurrencies are created because of demand for transactions, real world demand. So it's kind of different. But to answer your point and to answer your question regarding central banks and commercial banks, here's the thing. Bank of America is one of the biggest issuer of patents and biggest backers of blockchain companies since 2015. The NASDAQ, the New York Stock Exchange, PayPal, Goldman Sachs, they're all buying and acquiring companies or taking large stakes at companies that are in the blockchain sector. In fact, one of the new narratives on Wall Street is the fact that cryptocurrencies or any blockchain investment is highly uncorrelated with everything else that's going on in the stock market and in the bond market and in the real estate market. So essentially, by allocating some of your portfolio into them, you are lowering your volatility and you're increasing your diversification. And therefore, Wall Street is going to start to advise their clients to get into cryptocurrencies. Now, Wall Street manages around $30 trillion worth of bonds and stocks. If you see 1% of that entering into the crypto economy or the blockchain economy, that's going to create massive, massive growth. You got to realize Dave, it's true that the entire crypto economy is worth about $500 billion or $500 billion as we're doing this interview. But that was created only with $50 billion worth of cash entering the space. The rest is estimated to be the new coins generated from mining. So it's a cash economy. It's not a leveraged economy. It's not on margin. You have the room for an injection of new fresh cash from Wall Street clients, from the traditional investors, and that is going to be big for that economy. I don't see this going away. I don't see this interfering with gold, because there is no connection between owning cryptocurrencies and owning gold. The reasons to own them are completely different. When you own cryptocurrencies, or when you own a crypto project or a blockchain company, you're betting that this technology would be more relevant in the future, and that more people will use this technology. You're betting on technology. You're not betting on this becoming the favorable choice for people to transact with for most of these projects. And when you're buying gold, you're basically making sure that if there's a fiat currency crisis, you're protected with the one asset that has held through millennia in all currency crises that we've seen in human history. So very different reasons to own them. This is a growth economy. You're betting on growth when you invest in cryptocurrencies or in blockchain technology itself. And when you buy gold, you're not investing on with the premise that the gold market is going to explode. You're just making sure that you're protected. And if you own the equities, you're basically betting that their margins will be much better in the future, with gold prices being higher, and that you'll get leverage exposure by owning them. You're trading the gold shares. So very different mentality, and I don't see a reason why not to own both. For example, just to give you an example, 2 weeks ago, Wealth Research Group covered DMG Blockchain Solutions. It's a new company. It just started trading 2 weeks ago. It's already doubled from 80 cents Canadian. It almost touched $2. It's trading as we're speaking at about $1.50. And they had explosive news out. They bought a company out of Palo Alto. So they acquired a company to grow. Like I told you, this is a growth economy. So they made an acquisition. The company that they acquired is Blockseer, which is building blockchain applications. And on their advisory board sits, the most important person in the cryptocurrency world, Charlie Lee, the founder of Litecoin, who sold all of his Litecoin and is now moved from the crypto economy into the traditional stock market. Now, what does that tell you? That tells you he knows exactly what's going on with Wall Street and the fact that they want to come into this space big time. So he sits now at the advisory board of Blockseer, which was bought out by DMG Blockchain Solutions. And this couldn't be bigger. For you to understand this completely, this is a major step. He moved from the crypto world, where you buy your assets on the exchanges, to the stock market, where all of the big money still resides. $30 trillion worth of stocks and bonds. And so he did a strategic move here, and I think DMG will enjoy this move big time. This will attract a lot of institutional investors to the company. And what I really like about that company, and by the way, if you want the full report on it, like a comprehensive drill down on what's going on with this company, you just go to wealthresearchgroup.com/chain, like blockchain. And I've written an extensive report on this company because it's the only one that I've seen that was able to monetize blockchain in more than one way. So we already know you can create profits from blockchain by mining the coins, right? And we've seen miners in the past, and they're making millions of dollars mining Ethereum and Bitcoin. But this company is taking this one step further. They're diversifying. So not only are they mining for themselves, but they're hosting mining facilities or servers for clients. So you and I can't mine anymore on our computers, but we can we can hire DMG, and they can mine Bitcoin for us and send us our Bitcoin every day. And so that's a cash flow model, which I really like, because no matter what the price of Bitcoin is doing, that company still makes a steady cash flow. I love the fact that they're working with this kind of a model. It reminds me of the oil industry, where some drillers need to their share prices fluctuate with the price of oil, while the pipeline companies, they don't care the price of oil. They just care that the oil flows through their pipelines. So I really love that model. But what they did also is they went into fleet management, and that's the future of blockchain, Dave. Supply management and fleet management. So they have, for example, a joint venture with a cannabis company in Canada to make sure that all of the supply chain is visible for the government, so that the government can make sure that the quality of the seeds from inception to the consumer is of the highest quality. And that's going to go into many industries. The insurance industry will be on the blockchain. The diamond industry will be on the blockchain. Everything that needs more visibility and more transparency will be on the blockchain. And so they've done the same thing with a large fleet management in the US. They contracted with them, and now that fleet management company will know more about their customers. They will know if somebody is overbraking, if an oil change needs to be done, etc. And that will help them to lengthen the life of any vehicle and make sure that it's properly maintained by the customer. And whenever he needs to go in and change tires or whatever the situation with his car is, it's going to be easier to contact that customer. So the blockchain is changing everything, and it's making the world much more efficient. And I think this is something that's going to be major news. The fact that Charlie Lee has joined is basically now part of the DMG team. It's this very small company right now. It's only like $150 million of market cap Canadian. But with their mining facilities, it's estimated that they'll put in more than, I think, like $6 or $7 million a month. So for a company to be making about 80 million a year Canadian, and to be worth only 150 million, that's a huge opportunity. Again, so we really love that company. After months and months they were private, and they were taken public. By the way, just to end this, the management team, two of them are ex-Bitfury, which is the second largest mining company in the world for cryptocurrencies, and their founder, he's one of the pivotal people that brought Bitcoin to Japan, the largest crypto economy in the world right now. So just incredible stuff happening right now in the crypto economy. And that's why as a growth investor, I'm very, very interested in it.
Now, just to stay on this topic of cryptocurrencies, I mentioned Venezuela, where they created the Petro, or the Petros, and they're using that to bypass the dollar. And we're seeing a lot of other countries, they're looking to do the same thing. If they're sanctioned and they're having problems, they're looking to get around the dollar and go in a different direction. Now, does this mean that it's game over for the dollar then, if companies or countries start to do this?
I think it's very problematic for the dollar, because what these countries have done is basically, due to technology and due to the fact that we're advancing, they're finding new ways, viable ways to get out of the dollar system. And that's very, very bad for the dollar. The U.S. economy functions the way it does, with the amount of deficit spending that it does, with the amount of treasury auctions that it does. Everything that is done in the U.S. is based on the fact that the market will absorb no matter how many dollars they issue. And that's a great luxury that the U.S. Citizen and people living in the U.S. Are taken for granted, because obviously you don't think about this every day. But the reason that you can live in such a leverage to your own capabilities is because other people are buying your biggest export, credit. Realize this: if the budget was leveled, every person in America would need to pay about $50,000 a year in taxes for the privilege to live in the U.S. So if you take the entire budget and you divide it by the amount of people, each person in America would need to pay $50,000 a year in taxes. Dave, can people in America pay this? Can they afford $50,000 worth of living expenses, taxes to the government every year? Obviously, no. And so, who is paying for the lifestyle and for everything that's going on in the United States. Other governments, via their citizens, via their tax systems. So the U.S. economy is leveraged to the tune of $50,000 per person because the rest of the world absorbs their dollars, and it has for 46 years. But if the world stops accepting dollars or doesn't need them anymore, this is going to create a glut of dollars, a bear market for the U.S. economy, for the U.S. dollar, I'm sorry. And you're going to see countries opting out of this privilege tax that they're paying for and they're going to stop subsidizing the U.S. economy, and the U.S. consumer and each and every one of the people that are living in the U.S. will feel that in the bottom line. Every day you will feel this, because this will change the way that he can access credit and access loans and access cheap mortgages and everything else that is very unique to the U.S. economy. But when you move out of the U.S. and go reside somewhere else, you see that it's not that common for these things to occur. So it's a huge, huge deal. And I think what's more important is the fact that the countries that are trying to opt out are the countries that the U.S. sanctions the most. So Turkey, Venezuela, Iran, Russia, and these are countries that, if they're not on the dollar system and are transacting outside of the SWIFT system, that is going to create a problem where oversight on what they're doing with the funds is also very limited, and who knows what they will want to do with those funds. The U.S. has created a lot of enemies over the years with what they've done throughout the world, with coups and with intervention and with the CIA, black ops, etc. So you don't know the kind of retaliation that can happen. And that is one of the grave problems of the 21st century. You see, the world is progressing so rapidly in terms of technology. So we are getting to a point where human beings could do things that are incredible. But if we don't have the moral values, and we don't have the wisdom to use these technologies wisely, then we can be headed to an incredible reset in the world and many problems. As Einstein said, the First World War was fought with guns and tanks, and the Second World War was fought with bombs. The Third World War can be fought with smart nukes and all that stuff. But the fourth one, it can be bricks and sticks again, because the amount of power we have now is frightening, and we just want to make sure that the world doesn't get out of control. So it's very important for people to understand that this is a very unique period, and there's always the potential for a large reset, both economically, but also just in terms of things that can happen, disasters that can happen. And I'm not talking about Mother Nature. I'm talking about us as human beings.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work and get your reports?
Go to wealthresearchgroup.com. And then the best way to get all of our updated information, the newsletter and everything else, is to sign up. I launched Wealth Research Group 2 years ago, at the beginning of 2016. Before that, I was mostly in real estate. Over the course of 2009 to 2013, I jumped on a plane, came to America, and started a real estate business when no one else wanted to do real estate. And then in 2013, I opened up a unique boutique fund for about 20 well-to-do clients. And after we liquidated the fund in the end of 2015, my passion shifted to getting access to a larger audience. I didn't want to speak to the same 20 people every day. I wanted to speak to a larger audience, and that's how the idea of a newsletter came along. And I love investment research, and I do it for my own purposes. And so that's why we share opportunities also and publish opportunities on the Wealth Research Group newsletter. And that's what we've been doing for 2 years. Another thing that you can check out is if you want to sit down and get and check out some reports and get educated, is to go to the site, click on the special reports tab, and you'll see a wide array of just download reports on many subjects in the economy, from investment principles to the mining sector to the cryptocurrency sector, and anything else in between. And basically, that's it, Dave.
Lior, once again, thank you very much for being on the X22 Report Spotlight. I really appreciate it. Thank you very much.
Hey, thank you.